You got options. Execute your trade. You bet your money just got made. Convex.
Welcome to You Got Options, an exciting series right here on Top Traders Unplugged, hosted by none other than Cem Karsan, one of the sharpest minds when it comes to understanding what's really driving market moves beneath the surface. In this series, Cem brings his deep expertise and unique perspective, honed from years of experience on the trading floor to candid conversations with some of the brightest minds in the industry. Together, they unpack the shifting tides and underlying forces that move markets and the opportunities they create. A quick reminder before we dive in. You Got Options is for informational and educational purposes only. None of the discussions you're about to hear should be considered investment advice. As always, please do your own research and consult with a professional advisor before making any investment decisions. Now, what makes this series truly special is that it's recorded right from the heart of the action on the trading floor of the SIBO. That means you might catch a little background buzz, phones ringing, traders shouting, as Cem and his guests unpack real-world insights in real time. We wouldn't have it any other way, because this is as authentic as it gets. And with that, it's time to hear from those who live and breathe this complex corner of the markets. Here is your host, Cem Karsan.
Welcome back to another episode of You Got Options from the SIBO floor, brought to you by Kai Media and Top Traders Unplugged. Today, we come to you from the RMC floor in Munich, Germany. I get to talk to three different guests that were there for the conference. We cover some amazing things from emerging markets to volatility surfaces and the role of artificial intelligence. First, I talked to Keith DeCarlucci, the CIO of the Melgart Macro Fund. Talks about all the emerging markets and different commodity trades that you can use to diversify your portfolio. Next, we talked to Patrick Casley, president of One River Asset Management. He talks about how 60-40 is dead and a lot of the diversification that once used to benefit portfolios no longer works. Last of all, we talked to my friend Hari Krishnan, author of The Second Leg Down, and he gets into the weeds and the future of AI and how that's going to change markets for the long term. Hope you enjoy this one.
Yo, live it up, don't settle for less. You got options. Put your skills to the test. It's your call, time to strike. Make your move, grab the mic. You got options. Execute your trade. You bet your money just got made. Convex, time to straight the fade. It's the nexus of the game.
Hello, and welcome to another episode of You Got Options. Today from the RMC floor. We're going to walk through a couple different 20-minute conversations to talk about what's hot, what's happening here on the floor, and so with some of the best practitioners around. Today, we get Keith DeCarlucci. Thanks for joining us, Keith.
Thank you for having me.
If you don't mind, lead us off, giving the crowd a little bit of background on what you do exactly, and then we'll dive right in.
Sure. So I run I'm the CIO of a macro fund that trades cross-asset almost exclusively in derivatives. So we trade FX, commodities, and equities, with the exception of we don't do rates like most other macro funds do.
Very cool. And no better time than the present to talk about macro. I think, in the last 40 years, it's hard to find a period where there's more going on in macro.
For sure.
You mentioned you do FX, commodities, equity indices. Talk to me a little bit about each of those. What are some of the things you're most focused on right now and where you see some of the most opportunities? Sure.
I think what we see is most attractive on the FX side is, investing in some of a portfolio effectively of EM currencies. So things like Brazil, Mexico, South Africa, and Korea. Those have all benefited from what has been perceived or is perceived and has been weaker data coming out of the U.S. and softening against the dollar, or the dollar softening against everything. So they have an attractive profile from the interest rate perspective on the currencies, as well as the volatility perspective, because most of those have a fairly high risk premium attached to them. So between the volatility and the rates, it's quite an attractive portfolio. You just have to make sure you hedge the dollar portion of it.
Yeah, absolutely. And let's talk about each of those a little bit, if you don't mind. You mentioned Brazil. What do you like about Brazil in particular? I mean, you mentioned the rates, but talk to me a little bit more.
I mean, it's gonna be the rates and the vol that's the highest on both sides that's out there. I think that's alongside of what's been a fairly constructive domestic story. And once you got sort of Liberation Day out of the way, the flows have been quite strong. It's getting to the point where it might be a little bit stretched at this point. But we've switched from having options that had the volatility and the rate portion attached to it to more like just put spreads in dollar put spreads on Brazil, because it's kind of coming down towards the end of where we think it can go. But it's still pretty attractive on a daily basis.
You got to love the commodity profile of the country too, given the inflationary backdrop, et cetera. Right. Which is true for South Africa as well. You mentioned we had a really good bet on this year in Australia for similar reasons there. Different type of economy, a bit more. But yeah, South Africa is interesting too. And then you mentioned Korea. Talk to me a little bit about Korea. It's a little bit different in some ways.
Yeah, I mean, Korea is a bit of a different story. First off, it's not positive carry versus the dollar, like everything else is. But it's much more. That story is much more of a flow related story. It had been one of the favorites of the macro community being long Korea, and so much so that when it became overpositioned, like we were the other way, short Korea, and then it has massively retraced. So then we use that to re-enter on the other side, and it's a tiny bit technical, but we did that by selling upside calls. So Korea upside in the kind of 2-month area, and that's because there's 7 holidays coming in between there. So that's just an extra little kicker.
Yeah. Korea's super interesting as a location, FX aside, just because of all the auto-callables and all the structured products in the space, historic vol compression. Talk to me a little bit about if that plays into anything that you're doing, or all dynamics there.
Well, certainly on things like the auto calls and stuff certainly play into what we look at on the equity index side, because it affects all of that. The structured flow is it's coming back. It took quite a big hit in 2020, and it's taken a while to come back. But you now have a different risk transfer happening that used to be a lot more of hedge funds taking that risk off of banks on the auto call side. And now what you have is people like Jane Street just taking the auto calls directly, which is a big change in the structural dynamic of that market. But it's certainly something that we have to look at. And I think obviously with all the chip related things that are in Asia, that also plays into Korea a bit.
How much of the macro bets that you guys are putting on are a matter of kind of being a little bit more agnostic and just finding things that are cheap or expensive relative to history? And how much of it is actually making a macro kind of bet on outcomes?
Yeah, I mean, our macro strategy itself is called macro tactical and is much more trading oriented. So it's usually against positioning flows. Oftentimes you'll see things like that are where the direction of travel has been quite consistent, such that CTAs and systematic fully loaded on that direction. And you get, the last bit of people buying options in that direction on top of that. So the skew goes the opposite way, that you can take the other side, get paid to take the unwind. You don't even necessarily have to be making the bet that it's going to retrace back. It's just conditionally, if it retraces, it's going to be much more violent on that direction than the other.
Playing the distribution, which is what's wonderful with vol, obviously.
That is the wonderful thing.
Yes, absolutely. You mentioned commodities as well. Talk to me about what you guys are doing in commodities and where you see opportunities.
Yeah, I mean, I think, so right now, it's a good example of gold has had quite the run, even in the last week, to the point where, people are now paying for upside calls and volatility is going up on the top side in gold. This is one of these things where it's very steeply positioned at this point. That we're the other way around on the unwind. And you get paid to have the, sell calls, buy puts, risk reversal.
Yep.
A decent amount. It's very difficult to find any coverage people papers that aren't bullish gold at this point.
Right.
So usually when that happens, we're the other way.
So an interesting point from the data, we've done historical analysis on different commodities, particularly during the last period of rising interest rates, 60s and 70s, 65 to 82 type period, just to kind of study what does best and how does it perform? What's the distribution? A lot of people know that gold was the best performing asset from 65 to 82, right? That's pretty common knowledge. What most people don't know is it was also the most volatile asset.
Yeah.
And so the thesis to own long dated calls was a wonderful one, right? Especially 300% ago.
Yeah.
And I think from a macro perspective, likely will be if you believe the longer term pressures of rising interest rates, et cetera, that are out there. But I agree with you from a short term basis, it really is a function of volatility itself is still quite cheap in gold. Relative to the outcomes. And it can go both ways. I think that's what people have lost sight of.
I mean, as I said, we're trading oriented. I can't tell you where anything is going to be in 6 months' time, but
right. And how long is that bet that you're thinking about when you talk about,
so those are between 1 and 2 months.
1 and 2 months
durations. Yeah,
that makes a ton of sense, especially with what's going on the next couple of months. Really interesting. Outside of gold, any other commodities that you're thinking about playing in?
We're in and out of oil a lot, and that's more transparent story than gold because gold can have many different drivers. Oil has been, tends to be dominated by the CTAs and the systematic side on positioning as it goes one direction or another. So we've have been up into the early 70s. We were short. Now we're not. But it's kind of been trading. It's been range trading for quite a while now.
Quite a while.
With a lot of event risk sitting alongside of it.
Totally. And here's another aside, 60s and 70s. Oil vol, which most people would have been really high, was actually one of the lowest volatilities of commodities. And as far as commodities go, relative to longer term history is actually lower during that period. Yeah. Which is, again, something not that you would think. Again,
counterintuitive,
bullish, but very much like gold was bullish, but in a very different way. The trade in the 60s and 70s was to be long gold calls and short oil puts. Yep. Two very different trades.
Very different.
And I think we're starting to see that play out. We've been talking about that for a couple of years, but that's an interesting longer kind of mid to longer term dynamic.
I think the gold, the oil story is, as I said, it's the short term stuff is dominated by CTAs and systematic positioning. The long term story is always going to eventually be fundamentals, but it's very different from 15 years ago where you could count barrels and have a position in oil. Like the counting of the barrels doesn't tell you anything about the next 2 months.
Absolutely. Sometimes opposite. Oftentimes.
If you look at any OPEC decision, it often goes the opposite direction of what the decisions are.
Yeah. And that's not a coincidence. Honestly, people position for what they think is going to happen. And then reflexively, those flows tend to have opposite outcomes.
I mean, that'll be interesting to see what happens if the Fed doesn't deliver tomorrow.
I know. Great. Yeah, exactly. With everything priced in, it's almost priced to perfection, right? Completely agree. You mentioned when we were talking offline as well that that you trade relative value.
Yes.
When I think about opportunities in the vol space, I really think you can't get rid of risk, right? You can transform risk. Yeah. It's really about finding the right opportunity at the right time. So market timing, A, and then B, relative value, as we kind of discussed. What's cheap at a moment and what's expensive? And those are hard bets, but if you've been in the markets for a while, if you have a good look on history and what might be happening, you can find real opportunities. So we kind of talked macro and market timing a little bit. Let's talk relative value. Where do you see relative value opportunities in equities and other products, and how do you approach that part of that?
Yeah, I mean, historically, equities have been our biggest part of our relative value bucket. Generally, we don't have anything super secret in how we look at that, but we do have models and things that say like, how much is it out of line? And where the macro part comes in is, this is out of line. Is it likely to persist? If so, why? And that's against the macro backdrop. So for instance, we consistently right now will have, short, longer dated vol and equity indices and long, shorter dated vol. So 1 month, 2 month versus 9 month, 1 year kind of spreads, and collecting kind of 6, 7 vols in some of those, which is, very attractive carry. You just need to protect it whenever things, April comes along or something, or August of last year. And it's hard to find things more attractive than that in other asset classes because it doesn't get distorted that much. You have the change in the structured market and it has left less supply of back end volatility, which keeps it elevated along the way. So you want to be able to try to capture that as much as you can. And that really doesn't take place in things like commodities or, FX. You just roll it into macro.
And the theoretical basis for that, which I know you know, but I want to tell the audience a little bit, is, this is a well-established theoretical construct. Short-term volatility, historically, because of mean reversion, is actually higher than long-term. So if you play, short-term vol, it's actually better. But historically, because of risk premia, longer-term vol trades at a much higher implied vol. This was actually the thesis behind long-term capital management. Not to say that that's a bad. No. I don't. It's actually a great trade.
Yeah.
The key is structuring it in a risk-managed way so that you don't face an outcome like long-term capital management.
Yeah.
There's a reason Scholes, made that bet. The reality is they ended up being right in the long term.
Yeah.
They were just couldn't hold the trade. And didn't know how to manage risk properly, candidly. Yeah. So the reality is, theoretically, it is a long-term positive carry trade, incredibly positive return over the long run, and has a lot of great dynamics. I'll add to that, and again, I didn't mean that as a negative at all, because it is a great trade, but it's important to understand that it's a well-established trade and that there are risks to it, and it's very important to manage it properly and to manage the risk on it. I would add to that an interesting point, again, back to data. Historically, during that 60s and 70s period, the last time we saw interest rates secularly going higher, again, not a 1 week, 1 month, 1 year bet even, but if we think there are pressures with kind of the Fed takeover and all the structural geopolitical issues we're seeing of potentially higher interest rates, that 60s, 70s period is a very important one to understand.
Yeah.
And one of the things we find during that period is equities are even more mean reverting than any other time in history. From 68 to 82, I don't know if you know this or not, equities actually went nowhere in nominal terms.
Yeah.
So long-term volatility was awful in terms of a hold, right? Long-term volatility was a massive sell. But short-term volatility, due to all the geopolitical crises and everything that happened in between, was actually higher than history. So there's actually a macro framework that could say if interest rates go higher, you could see increased short-term volatility, but due to the nominal illusion of equities being priced in nominal dollar terms, you could really see a lot more mean reversion. So a really compelling trade, actually. This environment.
I mean, we've been through lots of wars and lots of crises, and I think we have a pretty good handle on how to hedge it. Largely, we'll be long convexity in the front end as a starting point to hedging, as well as strips of all the way up the curve of the VIX options to protect the term structure. And I'm talking like up to the 100 strike calls in VIX.
Yeah, let's talk about the long tail part, actually, a little bit more. So you said you're doing a strip of long dated calls?
No. Shorter dated calls, but higher strikes. The really teeny stuff that explodes in an April and that kind of stuff.
Yep. As you and I know, the price of those don't even matter. Yep. At the end of the day, it's the most convex moment on a distribution.
Yep.
And when something does actually happen, the price of those is, bid at, offered at nothing, right? Like at infinity. So couldn't agree more. Those are things that people try and sell to buy something else on a relative value basis, but more often than not, don't realize that it's the ultimate imbalance in supply and demand on the planet. Tend to outperform on those type of moves. And then what else do you do against those? So
that's for very deep crises, like this little bit of April that happened, or 2020, 2008. And then we need to protect sort of like the 5 standard deviation kind of moves. And for that, we use a product called variance swaps, where we're long, very short dated variance swaps, so 1 month and under duration, and short some plain vanilla strip of options against it to neutralize the outright volatility exposure. So that leaves you with a convex profile of the swap versus the linear profile of the option. So that works very well. And
and again, very few people understand that in the general public. But again, a great kind of well-established trade that does really give you, on a relative value basis, a really nice convex tail without the carry most times.
And I would add it also, another thing that it does that tail strategies have a problem with is it monetizes, because you re-hedge every day at the close, and that effectively monetizes every day everything that happens in a day.
Yep.
So you don't end up with like a March 20 happens and you're up 35% by year end, you're flat.
Right. No, there's a perfect match between the two strategies in terms of duration and timing. That's a great point. Really compelling stuff. Last question before we go.
All right.
If you have one opportunity that you think is particularly compelling in the next year, and we'll talk about it next year at RMC if you're here. Is there anything on your mind?
I mean, we already sort of talked about it. I really think it's consistently trying to harvest the carry in the term structure, of the equity thing. That's been very persistent. I mean, it's not as good as it was in 2021, but it's still pretty good.
Yeah.
And I don't expect it to change because it's fairly structural.
Yeah.
You just need to be able to hedge it.
And as we mentioned, particularly in this environment, and when you get that kind of match, that's really compelling. Thank you, Keith.
Thank you
for joining us. Welcome back to You Got Options. I get Patrick Casley here today from One River, one of the bigger thinkers in the space. I've actually been looking forward to this conversation for some time. Thanks for joining, Patrick.
Yeah, thanks for having me. It's always nice to get here in Munich and around Oktoberfest. I forced a nice pun on stage yesterday about a beer stein, and that was well received. So
I like that, the bubble.
Yes, the bubble. That's right. So
you want to tell everybody what that was, just so
it was a reference to the optimism in equity volatility specifically, but just markets more generally. You tip the beer stein, and I was referring to the classic German movie Beer Fest 2006. And
classic.
Yes, it goes back to the. So, anyways, you tip the beer stein or das Boot. It's a glass boot, and you can visibly see a bubble forming in the toe of the boot, and that air abscess, as it travels from the toe to the main funnel, creates this gurgling. It overwhelms the drinker. You fail the boot chug. So you kind of try to turn it to prevent that. And I think that's just a good metaphor for people and how they think they can see the bubble forming in markets. And there's any number of metrics one could pick to elucidate that bubble, but they think they can get out of the way.
Yeah.
So there's no need to preemptively hedge. I'll just react.
Yeah. Welcome to Voltoberfest. I think it's clear, like valuation wise, we're in some type of a bubble. Speaking of bubbles, but I think there's a lot of academic research out there that clearly states that trading in any period less than a decade based on fundamentals is an incredibly poor indicator.
Yep.
I like to think of it as a risk management tool. Valuations, I've given this analogy, are like if you're on an airplane, it's your elevation off the ground.
Okay.
The elevation doesn't really determine which way you go. Liquidity or gas does, right?
Yep.
At the end of the day. But once that gas stops for whatever reason, which it invariably will, then all that matters is how high off the ground you are, or how high that elevation is. We're full of metaphors today. But I do think that's a really good way to think about it. And I agree that bubble's kind of in the boot. The question is, when and how will that come? And that's where risk management comes in. And that's why, RMC, that's why we're here, all here. The big question is, how do you manage risk in the context of not really knowing when that bubble is coming down? Let's talk about that a little bit. How does One River do that? How do you guys think about risk? Let's dive in.
Yeah, One River we're a hedge fund, but we're also I would say allocation advisor to an extent. So my title is president and head of solutions. So we do that. We concoct solutions all the time. So the real kind of, if you were to make it into a problem set, you would probably say, how do I create one pool of capital such that I don't care if we have a right tail or left tail? And that's we're in a two-tailed distribution right now where people can really, we've witnessed and seem to continue to be witnessing with this Oracle announcement, this right tail melt up, the ability for large cap stocks to gap up 30%. It's just not normal, but it could be our normal for a number of quarters or even years. So you can't really afford to abandon beta. It certainly can't afford to abandon beta and lead against it at the same time. The foregone compounding could be too great,
right?
Especially in this benchmark aware world, right? However, whenever the dam breaks, it's probably going to break violently. So the metaphor I also used on stage was sumo wrestling. I think I've even heard you reference this one. You have deadlocked heavyweight opponents. You have bulls and bears. No visible kinetic energy, loads of potential energy in the markets. It's a very apt one. It's very true. So the way that we navigate that is we actually say it shouldn't matter where you are in the cycle. How do you create one pool of capital that doesn't care? So for us, we think I try to find high average return, negatively skewed assets. You need look no further than equities. You want to be passively long those in a low leverage way. And then against that, you want to be actively long, positively skewed assets. And you want to do that in a leveraged way. And you do those together. What's beautiful about that is you can convert those equities into futures, be very capital efficient. So $100 of equities, maybe you park $7 in margin, you have $93 to play with. You can buy VIX futures, VIX options, S&P straddles, equity index straddles, a host of things that are defensive. Put those together. Yep. So, for us, that is the way to do that. Your leverage on the equity market's beta 1, and you can be very active. And so ideally you have skill on the long vol side, so you can be dynamically participating, reduce the beta drag. But even if you're not great at that, you're probably going to compound pretty well.
I tend to agree. I think the one, it's always good to have a little bit of disagreement, and we all have different perspectives. I think the one part of this that I want to have people think about more in this environment, you mentioned the right tail, right?
Yep.
In this environment, not only is institutional short interest or the underweight is significant,
yep,
which tends to happen right before in a bubble,
yep,
for obvious reasons.
Yep.
Which in a supply demand basis is more likely to drive a squeeze higher, if we are to go higher. But on top of that, vol is very compressed, partially because we've slid, 40% off the lows.
Yep.
Which has driven us as well with all the ETFs, right, that are issued, all the call writing, everything that we're seeing out there has also driven this vol compression, all the structured product issuance. So you put that all together, coming out of a summer,
yep,
into an end of year where there's a lot of releveraging effects and all the things that we know that drive a lot of that seasonality. And you can't help but think that going into a midterm year with historic, policy coming out of not only the Treasury, but likely the Federal Reserve merging.
Sure.
It's hard to say that the right tail is properly valued at this point, given all those things. And
yep,
and so instead of operating from a beta perspective, and then taking in convexity on the downside, I think there's a great argument for replacing equity with out of the money calls and right tail. If you look at that distribution, equity markets are left skewed.
Yep.
So you're getting a discount to get a right tail that you could argue could actually be bigger than the left tail, although the left tail will eventually come, at least in some medium-term outcome. So agree, generally speaking, that vol, I think we agree that vol and using that dynamism of vol is critical in this juncture and kind of given how it's structurally compressed relative to the potential outcomes in this environment.
Yep.
I think we both agree on that. But I think in this environment, that right tail is really at a discount globally.
Yeah.
In a lot of assets, by the way, not just equities. But yeah.
And a lot of people, when you're right in that, a lot of people also don't appreciate that when you go buy an equity future, you do pay away cash to own that future. So you're going to have a pretty discernible 4% drag on that. So the S&P's up 10, the future's up, 7.5. Right. So you get that headwind as well. For us, I think the important caveat is the clients that we advise, large institutions, sovereign wealth funds, they are anywhere between 85 and 95% of their risk coming from equities already.
Right.
And so for them, I would say it would be pretty silly to engage too much right tail behavior. For the typical retail investor, I'd say they're actually more underinvested than overinvested at this point in time. So, for me, I use the F1 car port, too many metaphors, but
I love David Drudge's metaphor. Go ahead. Let's hear it. Yeah.
If you're going to embrace positive convexity, negative correlation, you shouldn't just put really good brakes on a car and drive at the same speed. Otherwise, you're just slowing yourself down. You need to drive faster as well.
Yeah.
So you could do that through additional leverage on the long leg to kind of compensate for some sort of beta drag or theta bleed. or in your example, buy out of the money calls.
Right.
Right. And then you're convex to the right and left tail.
Absolutely. Yeah, you can do it a couple different ways. And I think you make a really good point. For a lot of people, for somebody like me, that it's easy to deploy. But if you're already long equities, there are tax considerations to selling. There are also mandate issues, right? But to your point, and David Dredge, who we'll have on later as well, talks a lot about this. You don't just need the goalies, right? You need a heavy attack to pair with that. And I think particularly in this, leptokurtic kind of fat tail environment, I think that's critical. Let's pivot a little bit. We've talked kind of generally assets, equities. Do you guys have views on outside of equity land? Do you guys play in commodities, interest rates, FX? Talk to me, if so, about how you guys look at that and how you play in the space.
Yeah, we do high level. We're about 90% equities because our clients are about 90% equities. But across our firm, we do less convex but more defensive stuff like multi-asset trend following. We have 160 markets. We trade more or less everything under the sun: credit, commodities, FX. But the way we calibrate our trend models is to be defensive. So we're not trying to be the highest Sharpe ratio trend follower. Far from it. We're actually trying to be the most complementary to convexity.
To equities.
And so we're, if you look at the reliability of a long volatility, our style of long volatility, we're really good. The instantaneous, the big drops, the reliability will fall off if something gets more long in the tooth. 2022 is the prototypical example.
Yeah.
Luckily, we read a paper in 21, so we look pretty smart about it, to say that you should complement trend with convexity for the reason of a prolonged erosion of portfolio value. So we think macro assets are actually best rewarded over that kind of time frame. I call it the slow twitch muscle. So you have the fast twitch muscle of convexity there in the concurrent drawdown, the slow twitch muscle, which is there for the erosions. So we're constantly long kind of implicit out of the money options through these kind of trend following portfolios that will really ride the wave pretty aggressively.
So I think you've heard the sumo analogy that I gave, and you mentioned that earlier. I'll take one from you. I think I heard a couple of years ago, or maybe a year ago, is we live in a world of nominal illusion.
Yes.
And the reality is, I think very few people realize how critical inflation and real interest rates play into risk. You mentioned correlation, equity bond correlation breaking down in 2022. People have broadly for the last 40 years, and really it didn't exist until 40 years ago. I want to be clear about that.
Yep.
This 60-40 portfolio and the concept that those two things are counter-correlated and will protect you in risk is really an artifact of the last 40 years. If you take 125 years of history, you actually will find that there's zero correlation benefit between stocks and bonds, which blows most people's minds, actually.
Sure.
0.35 Sharpe for a full equity portfolio for 125 years, and 0.35 Sharpe for a 60-40 portfolio over 125 years. So almost no difference, essentially no difference.
And we've seen 2 times that since, over the last 20, 30 years.
Correct.
0.7 Sharpes.
Absolutely.
Which is obviously not the norm.
Right. And we understand why that is, right? Historic Federal Reserve policy. And the question is, can that continue into the future? And there's a lot of big question marks about that. And I don't think we need to dive into the structural arguments of why that may or may not be the case. But I think you have to realize that, there are structural factors that could very well lead us back to a normalization to more long-term trends. Again, looking at the last 40 years, interest rates top left to bottom right, and using that as your data set, I think we can all agree is probably not the right data set to be analyzing.
I think sometimes the simplest charts are the best, and we make this chart that's just a rolling 15, 10, and 20-year S&P excess of cash return.
Yep.
And it's simplest chart, but it gets us a lot of engagement. Over the last 100 years, we've been where we are now twice.
Yeah.
Once was the tech bubble. Okay, we know the best allocation choice would have been to hide under your desk for 15 years, embrace convexity and trend for sure. The other time, however, was in the 50s, post-World War II recovery. And we spent the subsequent decade crashing through all-time highs.
Yep.
More or less incessantly. So, it just goes to show that just because we're at all-time highs, this is your right tail argument. And I think you're absolutely right. So whether your construct is levered, passive beta, out of the money calls, you need to find a way to not run away from beta and be defensive at the same time.
Yep.
Otherwise, you're going to be making a short-term call on long-term data. And that's one of the worst things you can do, that mismatch.
So I started in 98. So I started right as kind of the tech bubble was going. And I think this will bring full circle some of that right tail argument. For the last 2 years into the tech bubble, the best trade by far and the easiest was to own long-dated calls and equities, like out of the money.
Yep.
Right? Those calls were way too cheap. Market up, vol up. Didn't happen just in brief instances like we've seen more recently, but it literally happened 8 out of 10 days for 2 years.
Right.
So it was a great way to capture right tail, make money on the way up. Hedge, by the way, you could sell stock against it.
Sure.
On the way up, and then eventually make money on the way down. You got a bit kind of a general megaphone into increasing rallies, which is what tends to happen for a lot of the reasons we've just discussed, right? So I think that, again, not to hammer on that idea, but that is a compelling argument. If you look to the 60s and 70s, though, to your point about the 50s, yes, we did hit a lot of highs along the way starting in the 50s. But again, nominal illusion, a lot of that was just a function of structural inflation.
Yes.
If you look at 68 to 82, 14 years at the end of that cycle, in nominal terms, we went nowhere.
Yes.
A lot of rallies, a lot of drops. However, we did lose up to 50%, like towards the end of that, 50% was the max. I think it was a 13-year period, 50% in real terms decline.
Yes.
I mean, that's not many people here could sit around and imagine a 14-year period where they lose 50% of their buying power by being in a 60-40 portfolio. And,
Sure.
and again, so valuations themselves aren't deterministic, but over longer periods of time,
Yes.
in real terms, and I think that's the key, not nominal, it tends to be very predictive.
Yes.
So a lost decade in a sense isn't just nominal necessarily.
Yep.
It's really a question of real.
Yeah, I think when stocks and bonds fall at the same time, drawdowns become the real drawdown becomes pretty eye-watering pretty quickly.
Yeah.
2022, the peak drawdown there was about the same trough as the GFC. Entirely different composition.
Right.
On the 60-40, completely. But in fact, the bond standard deviation was much more significant, obviously.
Right.
But the drawdown for that portfolio was the same.
Yeah.
Right. And I think if you revisit things like 73 and those types of the Yom Kippur type drawdown, if you shock portfolios today with that, we've raised the hypothetical. There's 4 quadrants of economic growth and inflation. You say, well, there's inflationary growth, which is intuitive, and deflationary recessions are intuitive. Yep. There's deflationary growth, which we've lived through. How about inflationary recessions? And when you kind of see prices meet that marginal elasticity to their peak, but they can't go any lower because people are not going to operate at negative margins. It's irrational.
Yeah, and you can't help but see some of the stagflationary pressures that would drive.
Yeah,
and so I agreed that's an outcome that not many people have thought about much for 40 years.
Sure.
But you can't help but see that at least the probabilities of that are higher than they've been in the past.
And I love the euphemistic language that slips in. You talk about inflationary recessions, and 95% of people I talk to come back with stagflation. I'm like, no, that's stale growth
right.
and inflation. I'm talking about a recessionary inflation, which is more in the 70s what we saw.
Correct.
Right?
And that's exactly what you end up seeing in the 60s and 70s.
Yeah, you're going to see some
agree.
real growth assets lose ground at the same time nominal prices increase.
We need a new term for that. Yeah. What's another we'll have to come up with that. But last thing I want to kind of touch on before we kind of wrap up here is I think an important idea that very few people are looking at in terms of risk. These days we have $500 trillion. Let that sink in. $500 trillion of long assets. That's stocks, that's bonds, that's private equity, private credit, real estate. That's globally. That's a eye-watering number. And at the same time, we have as non-correlated assets, and that's hard to define exactly, but in that number, I put precious metals, I put crypto, which is arguable,
Sure.
And then structured products and things that fall in the structured product umbrella. In that, I'm including all the new ETFs, all the buffer funds, all the things that people that are all at this conference do. And then I'm adding in hedge funds, right, broadly. And I get hedge funds tend to be more correlated than not, but they have a generally non-correlated exposure.
0.7 correlation, but low beta.
Yeah.
Sure.
And so you start putting those all together. Those assets are only about $15 trillion now.
Yeah.
Now, the caveat to that is people will be like, wait a second, precious metals are 25 trillion. How can that be? About 20 trillion of precious metals is underground, in safes,
Sure.
untouched, not accessible broadly. So I'm really counting that as 5. All of that 15 is up from 5 just 3 years ago.
Okay. Got it.
And the reason I say all this is they all have about doubled or tripled in the last 3 years. And that doubling and tripling of assets for all those is not a coincidence. They're all coming, in my opinion, from the same sources, which is people looking to manage risk and diversify in a world where bonds do not diversify risk.
Yep.
So big picture, 500 trillion on one side,
yep,
5 to 15 on the other side. Where do we think we are in that? And so I want to highlight, solutions like we're talking about, which is an element of that you can put that in the structured product hedge kind of part is critical. And I think increasingly critical. People are just early adopters are figuring that out.
Sure.
But we've yet to, other than 22, see any real reckoning there. And I think I just want to highlight that as a major risk.
Yeah, I think every asset in a sense can be viewed as a trading pair with the dollar.
Yep.
Right. And when you have dollar stability or regime stability, mean reversionary forces kick in. If something pops, it tends to come back. The dollar will rally against it. And that's another way of saying it lost value.
Yep.
But when you're in a reflexive regime, which is the opposite of a mean reversionary regime, you see this tripling of non-dollar assets over a very short time period. And that reflexivity tends to give rise to more reflexivity. And then there's some sort of crescendo.
Right.
And I don't think we've seen the crescendo personally, but it's also the hardest thing to predict in markets.
100%. I think it's safe to argue, at least I think so, super early, given the 500 to 15 kind of trillion type reality and the fact that we've yet to really see any of that mean reversion yet. And like you said, it's a pendulum.
Yep.
So once it starts to swing, it can really get going in the opposite direction.
Yeah. So all these dollar off ramps and the exuberant price moves we've seen, I don't love forecasting asset returns, and so I really don't. But I think if you're looking to hedge real losses, equities are tempting, but real assets have to be a big part of your portfolio, certainly bigger than they've been. I remember going back to 2015 when commodities were a bit of a swear word. We had risk parity portfolios that I was, helping kind of manage and market on behalf of AQR, and nobody wanted to touch them because it was basically just levered bonds, and the only other thing you were embracing was real assets. Those types of portfolios, especially anything that elevates the presence of real assets in the portfolios, it's probably a decent allocation regime to think about in a reflexive dollar off-ramp regime, which is what I really think we're entering.
To your point, hard to say with conviction that it's definitely going higher or it's an incredible bet. But what I think is fair to say is it's a great diversifier at this point. And markets don't respond to fundamentals over a short period of time, but they sure do respond to supply demand.
Right.
And when you have that kind of supply demand imbalance, probably not a bad place to be allocated.
Yeah. And you see, just forward multiples at 24 on the S&P, trailing multiples flirting with 30. I don't know where the CAPE measure is, but it's got to be flirting with 40 now, which is basically all-time highs. Everything else is 50 to 2 times its median or average. We're clearly on borrowed time. Of course, with the caveat that borrowed time can last quarters and years.
Sometimes.
And that's in a period of time that matters for investors, especially when nominal costs are rising the way they are.
Absolutely.
Right. And so it's a very tricky time to make pivots. I do fear that people will lean a little bit too hard into the equity risk aspect, fearing the right tail, but fail to kind of appropriately calibrate the left tail.
Yep.
And that's broadly what we've seen with a lot of allocation shifts of late. Not ubiquitously, but just on average.
Yeah.
So we'll see.
Yeah. No, the key is thinking about it distributionally, right? And I think that's what's really hard for people to do. When they think about beta, they either need to reduce their beta or improve their beta. The reality is you can maintain the allocation, right? Maybe even get leverage to the right tail while still protecting your left tail. And I think that's where we are in this cycle. And wonderful talking to somebody who gets that. Patrick, thanks for hopping on.
Yeah, thanks for having me. Appreciate it.
Welcome back to another episode of You Got Options here at the RMC floor. third conversation for today. We got no other than Hari Krishnan. I remember almost 9 years ago reading his The Second Leg Down, incredible book, written a bit since then as well. But no better person to talk about tail hedging, market dynamics, and where we're going than Hari. Welcome, bud. Good to see you.
It's great to see you, and couldn't be happier than to be in Munich and to be chatting with you. So.
Yeah. We got to go get a beer together after this.
Oh, at least one, certainly.
So one of the things that actually just there was a session on was AI and options trading, kind of the effects it's having, where things are going. And I know you have some opinions on that. I do too. And I think they're all kind of, really speculating about current circumstances, how fast this is moving and the effects it's going to have. But I'd love to dive in for the next 20 minutes and kind of focus primarily on that, if that sounds good.
Let's go for it. Yeah.
Yeah.
Sure.
So, couple things just to give you a sense of how fast AI is moving broadly. In the demographic of college-educated men in the U.S. specifically, unemployment has gone from 4.7% to almost 9.5% in the last year and a half. Specifically, nothing has happened to the 4.5% unemployment rate for college-graduated women, and for high school or non-college graduated men and women, also 4.5%. Very few people can understand fully why that is. I think it's pretty clear if you look at the data and where it's happening, that's happening specifically to those working in fields that are using, technical expertise, not nursing jobs, not service jobs, not teaching jobs, really programming, accounting, legal, across the board there. So massive wave, and it's happening way quicker than people realize.
Absolutely.
I think.
Yeah.
Here in the derivative space, I think it's so important, and we're seeing a lot of quick changes as a function of options being relatively complex. People like you and me have studied or worked for decades, right, to kind of fully understand these things and to rise kind of to the middle top or the top or whatever of our fields and be able to kind of discuss these and understand these products. But their growth is tremendous as people look for more non-correlation and understand them more, and there's more network effects. My view is that AI is really going to help the broader audience move more away from a two-dimensional stock, bond, commodity investing type exposure to really access more the distribution of each product, to be more precise with their positioning and adopt what I feel like, and again, I know you drink the Kool-Aid as well, a superior way to position, a more precise way and flexible way to position. So I really see it as a coming revolution, not just for AI, but for options, structured products, anything that involves dimensionality, and democratizing it in a sense. I know that's probably going to sound like a little bit of wishful thinking, or the question is about timing, but tell me what you think about that, how you see it. I know you have a little bit different view, but would love to hear your thoughts.
Well, I have a strong view. It might be incorrect, but again, I don't have a crystal ball. If you think of machine learning, there's kind of a wide variety of fields where it's applied, always getting wider. And in some areas, it's been conspicuously successful. Autonomous driving, if you are able to control for the impact of mistakes, all the way down to finance. Finance is actually the kind of the frontier, or financial returns predictions is the final frontier in some sense of machine learning, because the signal to noise ratio is very low. And so teasing more out of the data is immensely powerful. Now, you know as well as I do that if you trade just futures, forget about the options for a second, if you can be right 52% of the time and trade a lot, your Sharpe can be immense.
Yep.
But even getting to that is tricky in lower frequency contexts using machine learning. So it's a challenge.
Yeah.
And one of the big challenges is, as you build a machine learning model, you're always playing a trade-off between something called model variance and bias. So in finance, what that means is you don't want a model to be too biased in the sense that you don't want it to always be long are always short. You want it to change its positions dynamically. Conversely, you don't want a model to be too unstable. So if you input a slightly different data set, you don't want the model to do something totally different.
Right.
The trouble is that for markets which tend to go up, like the S&P, at least in recent years, model variance is a big issue, and models simply want to be long a lot of the time.
Yep.
So I know there's a passive revolution. I know that there are lots of other factors driving. I know that liquidity measures and so on are indicators of ramping up equity markets. But I think the technical models that are increasingly used, maybe under the ML guise, have that, as you put it earlier, momentum aspect to them. Momentum and long bias to them. So fighting that bias is a real challenge.
Yeah.
And options allow you to do that.
How much of that is just a function of the data set, right? I mean, obviously, any intelligence of any kind, when only given a certain amount of information, will have, poor outcomes if they don't have the full picture. How much of the argument that it's not good is that we just haven't had enough data points, or that the tails in particular are underrepresented? And what if we were to take a much wider lens and at least drive enough simulations to create a broader data set? I don't know. Just would love to.
Well, tail risk, which is a topic close to your heart and my heart, and Dave Dredge's, who will come on at some point.
Yep.
That is one of the areas which is hardest to apply machine learning to, because machine learning tries to tease out fine structure in a mass of data. So you need tons of realizations. The stuff that occurs at the tails doesn't happen much by definition.
Mm-hmm.
So machine learning models don't have much to grab onto. And so buying the tails, which is something that I guess most respectable market makers, dealers will do just to keep going, is the defense against statistical unknowability, I guess. And so that's an area where you can combine machine learning and options.
Mm-hmm.
So you could have a futures program where you do all the statistical stuff.
Mm-hmm.
You aggregate huge masses of data, you do cross-sectional pooling, blah, blah, blah. And then at the tails, you just play defense. And that's the cost of doing business. And I get the suspicion that a lot of people in the industry who are sophisticated using these models are doing exactly that. And you might not see it in terms of options activity at the tails, although that has increased, but more clearly in terms of very tight risk controls. So positions that have been working and no longer work just get flushed out very quickly, not only to the downside, but to the upside. And that creates this sort of interesting situation where options add even more value.
Right.
Based on the fact that more is predictable within the narrow, not the narrow, but within the belly of the distribution, and everything else is non-modelable, at least knowing in current conditions.
Yeah. And do you think, I think what you're implying is that those participants who are increasingly using these things are not only poorly modeling those things or can't use them well to model them, but because they can't, are reinforcing.
Oh, absolutely.
Tails. Yeah.
Absolutely. I mean, if you have an edge and your edge doesn't apply to outsized moves, you just get out.
Yeah, you just cut your risk. And that obviously just forces
And we're seeing a lot
tail.
more of that.
Yeah.
And we discussed this previously as well, but short selling has become more difficult, or at least index short selling or short bias strategies have become more difficult as a result, because cutting risk doesn't only apply to the downside.
Right.
It applies somewhat symmetrically to up moves as well.
Yeah, absolutely. You know, I think it's particularly relevant given that, you know, the last 40 years have been really up until just a couple years ago in 22 maybe, have been fairly one note. I mean, there have been short periods of volatility, but volatility has come and gone quite quickly. We haven't seen also until 22 a major breakdown in any way with correlation. There have been ways to manage risk and to handle things, which is quite unique, honestly, to longer history. I mean, if you look at hundreds of years of market history, not just in the U.S., but also outside of the U.S., you know, the last 40 years is a bit of an anomaly. in the context of a
Absolutely.
bigger picture.
And it explains a lot of the dynamics we're seeing now. So we see a rich VIX term structure. Why? Because I think there have been more instances of the VIX popping from a low teens level in recent years than we saw previously.
Absolutely.
And so people are playing defense there. And that is not contiguous, and it's not consonant with what's going on in S&P options. So
Right.
there are lots of dislocations where VIX might be rich, but S&P offers value either on the upside, perhaps, or even on the downside in certain spreads. And that's created a lot of interesting situations that may not be resolvable. They're not really arbitrages because the players who could do the arbs are not positioned in such a way to do those particular ones.
Yeah. I mean, I think I always find the 1987 event that drove essentially the creation of skew in the indexes as fascinating. Most people don't know that there was no skew priced into the S&P 500 until the crash in 1987.
That's right, yeah.
Options were created in 1970. Like the SIBO was created in 1971. Put options were created in 1973. But there was no skew in the S&P 500 until 1987, 88.
Yeah, that's a great comment, and it is historically true. I wonder if there is an analog today with the call skew for the S&P.
That's right where I was taking this, absolutely.
Well, you kind of tipped me off, so I'm going to give you credit for that.
No, absolutely. I mean, I think we've started to see a significant, compression of vols on the upside that as a result of not seeing any structural inflation of any meaningful lasting time, due to a very stable monetary policy and regime, and a broad geopolitical regime, really for the last 30, 40 years. It's interesting that we're seeing those things, that stability of policy change dramatically, but without a reaction. And I really do think it'll take an event to do that.
And that's a great point, because if you go back only to the 80s, let's say, and you try and look at S&P earnings multiples as a function of inflation, you see something that looks a bit like a bell curve. So high inflation is bad for equities, low to negative inflation is bad for equities, and there's a sweet spot of 2%, let's say. And it all fits beautifully together with the Fed's recent thesis and so on. But that could all change. That's not a written in stone fact at all. Even as it is, it's statistically noisy.
Yeah.
And so high inflation could actually be quite good nominally for equities.
Agreed. It all depends on what kind of inflation, right? And we're also talking about
devaluation. That's great,
right? Especially in a regime, by the way, when 10% of all the top 10% of all earners constitute more than 50% of all consumption in the United States. That could be something where the wealth effect is more important than ever. And if you drive liquidity to the top with lower interest rates,
and there's a double whammy there, because if the top 10% are generally older, which they are, and it was previously assumed that older people consume less, the effect is even more dramatic than that.
Yeah. I started in the business in 1997, 98. And so my first several years were market up, vol up. Probably the only, other than briefly in 2007 outside of the U.S., really the only time I really saw that for a continuous long period of time. And again, it was almost 2 years of market up vol, which most people don't fully appreciate. So I've kind of been wondering if and when that would ever come back again. And I can't help but feel that slightly different circumstances, some things rhyme, like Federal Reserve policy and whatnot, which we can get into. But really the amount of short interest, the amount of retail involvement, obviously the power of narrative, all bubbles are built on a very believable idea that this time is different. And where you're let off with AI, like I can't think of a more powerful driver of that narrative. So in the face of that narrative, retail involvement, very aggressive coming monetary policy likely, given that the administration is taking over the Federal Reserve. All the ingredients are there again.
Well, I'd like to make a cheap comment about that this time it's different. I'm actually quite sympathetic to young people, because if they didn't believe this time is different,
What
They
hope
might
is
think
there?
that we're going to get old. We're going to get old and sick, and then we're not going to do very well. At the
Oh,
end.
yeah.
So they have to feel this time is different. It just doesn't really apply to financial cycles, which outlive all of us. So, yeah.
And by the way, it could be different. We were talking about tails, right? Like, you know, the reality is there may not be enough data. It's possible, but that possibility is what drives the exuberance and the drive to some extent.
Well, I think one of the most interesting case studies will be what happens to the crypto vol surface over time.
Yeah.
That is a very nascent surface. It used to be flat and high.
Yeah.
What contours will it take?
Yeah, let's talk about that a little bit because I don't play as much in crypto vol.
Nor do I.
Yeah.
So, speaking a little bit out of field. But
I definitely think, by the way, and this is a little tangential what we're talking about, but that there is a massive right tail convexity, as we've seen in crypto, but also extending not just to crypto. And now, again, we've seen it recently in precious metals. We talked about
gold,
that for years.
platinum.
Yep. But across any asset that is really perceived as any type of a diversifier, you know, people don't realize the growth that we're seeing in structured products, which I often talk about. And in structured products, I mean also the ETFs and the buffers and all the things, right?
Yeah.
Which are all very related. That's gone from 500 billion to 2 trillion in just 3 years, which is pretty amazing. Hedge fund assets broadly have gone from 2 trillion to 4 trillion in about 3 years. Gold has tripled in 3 years. Crypto has tripled in 3 years. What I don't think many people have connected is all those things are connected.
Absolutely.
Yeah.
I mean, even if you take the hedge funds piece, if the bulk of the flows are going into the pod shops, and the pod shops have very tight limits, risk limits in each pod, what are you going to do other than chase a winning strategy and bail out or get bailed out if things go against you?
Right.
You have to do that. You can't be a long-term player. That's where the opportunities lie for some of us.
Yep.
Michael.
Absolutely. But all of that's, you know, you have 500 trillion on one side, and now you have up from 5 trillion, 15 trillion of diversified assets. But that's all happening in the context of just a warning shot in 2022. Not really, I mean...
And it was a mild decline. I mean, it was significant in terms of distance, but not in terms of speed.
Right. That's exactly right. So, I mean, I can't help but feel like, you know, talk about right tail events. We're already seeing it in those assets right now. And that's before the liquidity push coming from an activist Federal Reserve likely coming, and an active administration. So you can't help but wonder, you know, how fat should that right tail be and how much of that can not just continue in those assets, but even translate across all assets going forward. And all the time in the context of structurally compressed vol on that tail. You know, it's the harder part, honestly, is owning the left tail because it's expensive. Everybody needs it. Everybody's long assets. Everybody needs it. The cheap part is the right convexity. And because of that structural imbalance of long assets for short assets, we have compression on the call side. But again, I think that is that's exactly at the moment, right?
Place to play.
Yeah, it's the place to play. Anyway, we kind of moved off of the AI piece a little bit, but I do think that AI also could potentially play a role in that.
Well, we do a lot. Well, just to summarize the AI piece from my perspective, we do a ton of AI or machine learning. I won't glamorize it in various guises, but it's always dedicated to median return outcomes. So the need for options never goes away.
Right.
You have to look at median return outcomes because these are pre-leveraged numbers and you don't want to be glued too much onto rare events.
Right.
Because machine learning requires very repeatable patterns that occur many, many, many times. Fine structure cannot be found from a sample set of 10.
Yeah. No, I agree with that. The question, I guess, ultimately is how durable is that weakness in the models? And, you know, like you said before, I don't know that our edge, our views, the contextual thinking that you need outside of an AI model will go away in a year or two. But I think it's safe to say with stronger models, better data, that you could, in theory, also start modeling more complex things like that, which are actually more valuable, in the sense that it's hard for most people to access that, maybe even you and me at times.
I think it's hard for me as well, but it's, of course, there'll be windows of opportunity in these spaces.
Yeah.
The reflexivity of markets, though, will always create something new.
That is not going away.
At least that's our hope.
That we can agree on. Awesome conversation as always. Thank you, Hari.
Thank you, sir.
Always a pleasure.
You got it.
You bet your money just got laid. Convex.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to your favorite podcast platform and follow the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged. But before we go, we just need to remind you that this podcast expresses the view of KaiNexus LLC and the guests appearing on the podcast as of the date of its recording, and such views are subject to change without notice. KaiNexus LLC and Top Traders Unplugged do not have any duty or obligation to update the information contained herein. Furthermore, KaiNexus LLC and Top Traders Unplugged make no representation to its accuracy, and it shall not be assumed that past investment performance is an indication of future results. Moreover, wherever there is a potential for profit, there is also the possibility of loss. This content is made available for educational purposes only and should not be used for any other purpose. The information contained in this podcast does not constitute and should not be construed as investment advice or an offering of advisory services or an offer to sell or a solicitation to buy any securities or related financial instruments in any jurisdiction. Certain information contained herein concerning economic trends, performance, and other data is based on or derived from information provided by independent third-party sources. KaiNexus LLC and Top Traders Unplugged may believe that the sources from which such information are obtained are reliable. However, each of KaiNexus LLC and Top Traders Unplugged cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. This podcast, including the information contained herein, may not be reproduced, copied, republished, or posted in whole or in part in any form without the prior written consent of KaiNexus LLC and Top Traders Unplugged.